Do you know insurance? More expensive every day. Today on Zippy Point. I'm Brock Romanek and I'm a big fan of yous. Over the past year, many policyholders found that the cost to renew their coverage was substantially higher than what they had paid before. It's a take it or leave it market, a hard market. Here are 5 things that you need to know about D&O coverage. 1. Don't overdo the coverage. 2. Pick a proper level. 3. Hire the right people to negotiate. 4. Entice quality director candidates. 5. Don't forego your insurance. 1. Don't overdo your coverage. Here's what I mean by this one. It's a fundamental structure issue. It's a fundamental structure issue. Think of D&O coverage as a big pot of money. If you continue to add more and more people within the company, employees, the in-house lawyers, as well as more and more types of incidents that are covered by the policy, they're going to be less for the directors and officers to dip into when they need to. So if your broker tries to sell you a policy with truly comprehensive coverage, don't necessarily think of that as a good thing. You'll deplete what's left for the group for whom the insurance was originally intended for. 2. Pick a proper level. It's not practical to get coverage for everything. Some directors want the kitchen sink, cost be damned, but you should only be getting coverage for items that relate to a fiduciary duty. Other types of insurance you might already have cover the other stuff, the ceiling falling in during a board meeting. They might not. The role for the D&O insurance is to provide coverage only for the directors and officers in the context of their official duties to the company. 3. Hire the right people to negotiate. This point is all you really need to know. This clearly is an area where not one size fits all. You shouldn't be accepting a policy just off the shelf. It should be heavily negotiated. You need to closely negotiate the finer points of your policy. A comma, a few words here and there, they can really matter when it comes down to make a claim. And when I mean you should negotiate, I really mean you need to hire an experienced broker to negotiate on your behalf. You should not be the one to do it. You shouldn't be the one to do it. Your normal P&C, property and casualty broker, shouldn't do it either. P&C, property and casualty, is worlds away from D&O insurance. It's like asking a securities lawyer to handle estates and trusts. It ain't gonna work. It takes 3 years of training before a broker is really fully qualified to negotiate D&O insurance. 3 years! Without someone who's experienced, you're just not going to get the best price. You're not going to get the best terms and conditions. You're really doing yourself a huge disservice. You might even want to double up with an experienced lawyer too if your broker is not a lawyer, or the brokers are lawyers, to have a second set of eyeballs on the thing. Again, D&O coverage really is all about the legalese in the policy, so you need someone able to understand that legalese to be able to go through the policy with a fine-tooth comb. I haven't had a comb myself in a while. It's particularly true if you have unique circumstances, like a stockholder-nominated director on your board. 4. Entice quality director candidates. When being interviewed for a board seat, director candidates typically get a one-page summary describing what your D&O insurance coverage is. They really don't need to see more than that, and most really don't ask for more than that. They don't need to see a benchmark. And if you're recruiting quality directors, it's possible they're going to want to see your actual policy. Perhaps they know what coverage your peers have had for their board. Maybe they'll ask to boost the coverage that you have. So you might need to be pretty familiar in this area to talk to them, or at least get this person within your company who really knows your D&O insurance policy. It might be your chief risk officer, or connect them with your outside advisor in this area if you have one. 5. Don't forego your insurance. So Elon Musk made news last year, doesn't he always, when he had Tesla drop their D&O insurance coverage. In its place, he said that he would indemnify the board himself with his massive wealth. The mass media picked up on this development and has led to other companies pondering whether they should do the same. There obviously are conflict issues to consider. What if the CEO decided to fight and threaten not to pay a director's claim as a way to unduly influence that director's thinking? The CEO's discretion about what to cover can be really used as a cudgel to control the board. Or this arrangement could lead the board to take steps it otherwise might take to ensure that the CEO's wealth stands up so that the CEO can make good on his promise to act as that D&O insurance coverage backup. So the director's interests might become more aligned with the CEO's interests rather than with shareholders generally, arguably. And then there are gap issues. Some types of liability are just not permitted to be indemnified. For example, the SEC has long taken the position that indemnification for violation of federal securities laws is against public policy and enforceable. That's where D&O insurance coverage steps into the breach to handle those problems that indemnification can't. So don't forgo that D&O insurance just yet. I have a series of other Vid-Guides about D&O insurance, including what's the difference between D&O insurance and indemnification. So you can go to zippypoint.com to see those, or look beneath for links at least to some of those videos.